next.
And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
And good morning and welcome to the second best day of the week. Of course, it's Thursday as we get ready to wrap up this trading week and head into the next big week of earnings. So we've had a lot of earnings out this week already, but all the big boys are coming up next week. So it's Apple, Microsoft, Google, those are going to be Amazon, all going to be kind of your headline earnings reports next week. NVIDIA doesn't come until late November, so we won't get that one until much later on. But next week will be chock full of data from the big mega cap, Mag 7 kind of players that are really going to kind of set the tone for the markets in terms of moving in towards the end of the year. But again, so far so good with earnings. Earnings haven't been fantastic. They haven't been terrible. They've just kind of been right as expected. We'll get some more data on this next week as we kind of start to get into the bit. There's a kind of a torrent of earnings reports coming over the next week as we get ready to wrap up the month. By the end of the month, we'll have, basically all of the S&P 500 will have reported, except for a few stragglers going into November. But we'll have a very good flavor for what earnings look like by the end of next week. Of course, today also is retail sales numbers days. So today we're going to get a look at retail sales for the month of September. Now, there are some things that have been going on this year with the calendar. Labor Day came a little bit earlier than usual, and some other kind of calendar events that kind of shifted the calendar a bit suggest that we're going to see an outsized seasonal adjustment to the retail sales number today. So expect a blowout retail sales numbers. Expectations right now, I think, are about 0.2%, 0.3% growth for retail sales. That number is probably going to be closer to 0.8 to 1%. It's probably going to be pretty high. So you're going to get lots of headlines out this morning about, wow, the consumer is so resilient. It's amazing how strong the consumer is. They're out spending money, no doubt. We're coming up on October. My wife alone has been supporting the spending for the holiday shopping season of Halloween over the last week. So retail sales numbers are going to be good. But a big chunk of this is going to be the seasonal adjustments behind that. Of course, we'll likely see those numbers adjusted as we go forward and see those numbers come down a bit. But expect a very strong retail sales report out this morning. That should give a lift to markets just from the standpoint that the economy is doing fine. The other takeaway, though, from this, from the kind of the negative view, is that the markets may say, well, wait, if the consumer is doing that well, maybe the Fed doesn't need to cut as much. And so, maybe it's a negative. We'll see how it turns out today. It's always hard to tell. But right now, futures are pointing up about 24 points on the S&P right now. Netflix reports after the bell today, so we'll kind of get a look at what they're subscriber and streaming revenue looks like. And again, that'll kind of start to roll out and talk about Disney and other streaming services as well. But that'll be the big report after the bell today. Outside of that, economically, there's not a whole lot of reports today. We've had export-import prices yesterday. Again, nothing right now is overly concerning about the markets. Now, everybody's kind of focused right now on the election that's now very rapidly approaching. The election just really 2 weeks away for the most part. And of course, once we get past that, we're going to start to have buybacks come back, as we talked about yesterday. That's $6 billion a day starting in November. So, the big focus is going to be this election and what happens, whether or not it's contested, whether or not it's we get through this fairly easily. Is there a clear winner? Is there a clear loser? We'll find out. Then the markets are going to have to adjust for whatever policies. And again, just remember, when it comes to the election, it's not really the president, right? It's really the control of the House and Senate. What the market likes is a gridlocked Congress, because it doesn't really matter who the president is. He can run around and talk about anything he wants all day, but if he can't get anything passed through Congress and Senate, it doesn't matter. So what markets historically like is a gridlocked House and Senate. So a Republican-controlled Senate or in a Democratic-controlled House or vice versa. That's kind of the best outlook for the markets. We'll see what happens. So really what's going to be important about the election is not just who wins the election, but who wins control of House and Senate, and whether or not that is a unified win or a gridlocked win. We'll see what happens. So, having said that, markets are doing fine. Again, nothing to worry about. Lots of consternation about the markets. It's interesting. I get more and more videos every day about really negative outcomes for markets. But here's what you need to know before the bell this morning. Despite all these videos that are coming out talking about kind of the end of the world, the market's going to crash. I saw several just from 2 or 3 months ago. People have been emailing me lately. The markets are going to crash by the end of the year. The economy is going into a massive recession. This October looks a lot like October of 2007. Maybe. There's plenty of headlines out there. If we go back to the soft landing scenario, you go back to 2007, lots of headlines back then talking about, hey, it's a soft landing, Goldilocks scenario, Ben Bernanke, right? All that. And so, yeah, there's certainly a lot of the similarities between the two markets in terms of headline events. But again, the market right now isn't suggesting any of that. We've been continuing to make new highs here lately. The market's continuing just to kind of grind higher along this bullish trend line. And again, we keep kind of setting a rising trend to the market that's very important. And again, we're on a buy signal right now. Now, stocks are a little bit overbought, and this is the subject of today's daily market commentary, which will be out in just a few minutes on our website. It's actually live now. If you go to realinvestmentadvice.com, it'll be emailed to you at 7:30. But we talk about the fact that you can have a very bullish market in terms of we have a seasonal buy signal in place on a weekly basis. We have a market trend that continues to be very positive. We continue to just kind of set higher lows as we kind of go up. We are getting a much more defined kind of ascending wedge in the markets as well. Eventually the market's going to have to break out of this in one direction or the other. But the trend of the market is still very bullish. But with that same context, right, you do have risk. We are as we talked about previously, we are getting very deviated from the 50-day moving average. With the MACD buy signal here is at a very high level, which suggests that a correction is very likely possible. So we continue to suggest, managing the risk in your portfolio right now. Don't just, go reckless abandon into the markets, but there's also no reason to be overly bearish about the markets. One thing we're going to talk about with Michael Leibowitz this morning is this rise in the VIX that we've had just recently. And really, what is that signaling, if anything, right? But again, when the VIX is rising, everybody starts coming out with very negative headlines. Oh, the VIX is rising, a market crash is coming. Maybe. But see, this is the trick to managing money, which is to understand that the markets will trend higher until they don't. And again, you're going to have signals that come along that tell you that risk is becoming elevated and that you need to be more aggressive about your risk reduction. We're just not currently in that environment right now. The markets are trending fine. Buyers and sellers are well aligned. Plenty of liquidity coming into the markets right now. Global liquidity on a relative basis is at some of the highest levels that we've seen really since the financial crisis. It's just been a very, very sharp rise in global liquidity, which is all fueling into the markets around the world because there's nowhere else for the money to go. So again, remain positive right now. Continue to manage your risk because we do have some short-term risk that the markets could pull back here a bit, which would give you a better entry point to add money into the end of the year. But again, also November, December, we have buybacks coming back. Earnings season will be behind us, and again, it's kind of that end of the year holiday shopping push. So lots of reasons why markets tend to rally into year end, and a lot of portfolio managers are trailing markets this year. They're going to have to play catch up by year end. That's going to help push markets even higher through that point. That's what you need to know before the bell this morning. We'll come back, pick up with Michael Leibowitz on the VIX and what it means about volatility. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
Medicare open enrollment starts October 15th. If you need Medicare insurance coverage, RIA Advisors can help. Understanding Medicare choices, enrollment deadlines, and costs are essential to your overall standard of living in retirement. The wrong choices can cost you thousands in lost benefits and penalties. Make sense of Medicare's alphabet soup with RIA Advisors online resources and one-on-one partners to help secure the healthcare insurance choice that's right for your lifestyle and budget. Click on the Insurance tab at realinvestmentadvice.com today. realinvestmentadvice.com.
Small businesses are now being challenged by the lack of employees and how to attract and recruit the best employees. To get the better employee, you'll have to offer a better package. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Don't assume a 401k plan is too costly or complicated for your small business to offer. Let us show you how to make the most of an affordable and effective plan that will deliver true value for your business and your employees. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com. That's realinvestmentadvice.com.
The Real Investment Show.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning. At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
And welcome back to the show this morning. So lots of conversations. Again, I've just been getting just swamped with emails lately because the bears are out on parade right now, which is kind of interesting at the moment because, you know, I'm getting emails from, oh, this guy said this about interest rates. This guy says this about inflation. You know, articles out this morning that, you know, this is like 2007, October of 2007. We all remember what happened after that. And again, as I was saying earlier, there's certainly always reasons to be concerned about things, but, you know, there seems to be a whole industry of, you know, people trying to get clicks and views and these type of things by, you know, simply finding every bit of data and saying, oh, this correlates to this period, so that means this is about to happen. And that's not the way markets work. There are, you know, and this is the problem. I hate analogs. You see these all the time. It's like, oh, look at this market. It overlays with 1999 perfectly. And you know what happened next, right? The problem is that price patterns can repeat, and they do repeat from time to time, but things are different. And every kind of situation is different than it was before. And 9 times out of 10, these analogs break, and it's like, oh, this is just like what happened, and then the market just keeps going up or whatever, right? And then you never hear about that analog anymore. So, that's just kind of the things to remember, is that, yes, there can be similarities in markets to previous market environments, but the underlying dynamics are different in many cases. Now, look, there are certain things that will eventually happen. Valuations will mean revert at some point, right? But again, that could be years before that happens. So it's important to also understand the duration of these calls. And so I get a lot of emails from different people that are sending me emails of videos and things they're watching. It's like, the massive housing crash, it's coming. It's right around the corner, but they never give you a time frame. And, the one thing that Mike and I and everybody here on the show tries to do is that when we talk about things, we always try to quantify them and give you a time frame and say, because that's important. It's okay to make a call, right? But we have to give you a time frame for that call to work. Otherwise, it's not really a valid call. I can say, look, I can sit here and say the market will definitely crash, right? And someday it will, right? It could be 20 years from now, but someday the market will crash and I can say I was right. But that doesn't help you as an investor. We have to keep focused on, what's going on now in the markets, managing our portfolios for what's going on right now in the market, and then make sure that the outcomes that we're looking for are within a reasonable time frame that we can manage for. And that's why we always try to say things like, look, over the next week, this is what we expect to happen. Markets are very elevated. We're going to have a 3 to 5% correction at some point over the next couple of months, right? So we try to time frame that for you. And then we can say if it doesn't happen, say, well, it didn't happen. We were wrong. And then we can go to our next call, right? So this is important. Time frames and duration and have to be matched with a call. Otherwise, the call is not valid. So just kind of saying that. Now that brings us down to the volatility. Mike wrote an article about volatility this week. It's a very good article. I suggest you read it. It's on the website at realinvestmentadvice.com. And it has a lot to do with exactly the same thing, because I've been getting a ton of emails as of late talking about this rise in the volatility index, and it's got to mean something. And that's not necessarily the case. Volatility always tends to rise prior to an election because we just don't know what's going to happen in elections. So you see a lot of hedges going on. You see a lot of things that are happening. But it doesn't necessarily mean that the market's about to crash. It can, though. However, other periods in history where we've seen a rising period of volatility has led to market corrections and bigger crashes, right? So it's important to have context. It's important to understand kind of where we are, and it's important to understand what volatility means. So, Michael, let's start with the very basis of volatility is often viewed as the fear-greed index. What comprises it, and why does it represent fear and greed within the markets?
Well, so what it is it's implied volatility. It's not volatility. Volatility is the past. That's called realized volatility. Implied volatility is the market, what the market thinks volatility will be. So what does volatility mean? It just means how much the market will move. Will it move a lot? Will it move a little? But what that doesn't define is, will it move up or will it move down? It just means it's going to be moving. It's, you're going on a cruise. Is the water going to be choppy or is it going to be flat? And that's what it's telling you. But it's not telling you, again, whether it's going down or up on its own. And it does that by looking at options contracts on the S&P 500. And you can get implied volatility for every stock has it. And it's a very good trading tool. Looking at implied volatility versus where it traditionally is. Looking at the potential events that are coming up over the net volatility measures, VIX is for the next, tells you the range of volatility for the next year. So it kind of gives you an idea of things that could be on the horizon that could upset the market or create a lot of joy in the market if the market goes up. So let's just talk about what the VIX means. So for argument's sake, let's just say what's the VIX, like 19, 18 right now?
Yes, 19 coming down a little bit.
19. So that means that the market thinks that within the next year, the market will stay in a range of 19% up and down from where we're at today. So in the article I just wrote, I used 22. That's what it was about a week ago when I wrote the article, and very similar range. What that meant at the time was that the S&P, the market thinks the S&P could get as high as just over 7,000 and as low as 4,500. That's nice, but it's not telling you. It's telling you the market expects choppy waters, but it's not telling you it expects the 20% increase or the 20% decline. And to do that, there's other indicators that can help us understand. Again, this is not going to happen. The market is not going to trade in that range perfectly, hit the high, hit the low, hit the high, hit the low. It's what the market expects. And those market expectations change second by second. If we just look at where the VIX was recently, it was as low as 12 or 13, which implies the market's barely going to, it's going to move between 5,000 and 6,500. And it was high as 37 when some of the Japan carry trade shenanigans were going on, which implies almost 10,000 and almost 3,600. That was all within the last year. So like everything else, you have to take the VIX with a grain of salt, but also look behind it. And there are other indicators. One, for instance, is the put call skew. And what that's doing is looking at the prices of puts versus calls. Are people paying more for puts than calls that are identically distanced from the strike price? Now that starts giving us information. That'll tell us if the put call skew is high, people are paying more for puts than calls, people are getting bearish. Sentiment is turning down. They expect excuse me, they expect more of that lower end of the range to be attained. Again, they expect it. Doesn't mean it's coming true.
No, and what's interesting is right now too is that there's a couple of important parts with volatility, and just like we look at the market technically, and we can say, well, the market's got a sell signal right now, or it's got a buy signal. We can see the same thing within volatility. So we can look at the volatility index and we can tell from that whether there are, kind of the trend of buyers versus sellers, those buying puts or those buying calls, is trending in a positive or a negative manner. And for instance, right now on the VIX, it's triggering actually a MACD buy signal, which suggests that volatility will be going lower. And again, it's down from 22 to 19 already. And which is supportive when volatility is falling, then that's supportive of higher prices because people are becoming more confident about market trends. There's less concern about a market crash, so they're not hedging as much. And so some of these technical overlays also can help us determine the direction of where the markets are going to go by the trend of where the VIX is headed versus just the actual level of the VIX.
And that's important too, because the VIX doesn't necessarily trend. It doesn't increase consistently like a stock. It kind of hovers around a kind of average level, and then occasionally it spikes, and occasionally it drops below that level. Not does it drop down to zero, but if we consider 15, 16 as historical average, it's gone as high as the upper, near 100. And it's gone as low as 10 or 12. So it's not, it's not a buy and hold instrument. It's an instrument to, a lot of people short it, right? Because ultimately, like you said, Lance, there will be a crash. The VIX will get down back to 12.
Right.
We know that. So if you short it today and you just wait till it gets to 12, you'll make money. Now, that said, you're probably going to get margin called and could lose your house, if you're wrong. But
right. Well, that's always the risk. It's just like the article we talked about on Tuesday where the guy lost $415 million trading options on Tesla. When things go wrong with options, they go wrong really fast. That's the thing about them. When we come back, I want to talk a little, kind of finish up this conversation with you on the VIX. But we'll talk specifically about, how to use the VIX to help manage your portfolio a little bit better. And we'll, kind of go through a little bit of historical work on that as well. So more with coming up on volatility and the VIX right after the break with Michael Leibowitz.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
Medicare open enrollment is underway. If you need Medicare insurance coverage, RIA advisors can help. Understanding Medicare choices, enrollment deadlines, and costs are essential to your overall standard of living in retirement. The wrong choices can cost you thousands in lost benefits and penalties. Make sense of Medicare's alphabet soup with RIA advisors' online resources and one-on-one partners to help secure the healthcare insurance choice that's right for your lifestyle and budget. Click on the insurance tab at realinvestmentadvice.com today. Realinvestmentadvice.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets. And unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. Just simply click Ask a Question at realinvestmentadvice.com or give us a call at 855-RIA-PLAN. That's realinvestmentadvice.com.
The Real Investment Show.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
Slept right through my alarm this morning. My wife woke me up. I was in the middle of this dream when she woke me up of the alien armada coming to Earth.
The Real Investment Show podcast.
My wife's ex-husband's new wife is a flat earther. She believes the Earth is flat. And so in my dream, the alien armada is coming to explain to her that the Earth is actually round.
Same show, your schedule.
Nice.
Anyway, I woke up late, so here I am.
Bet you Richard could do a script treatment of that one.
At realinvestmentadvice.com.
I'm thinking more like Mars Attacks. That was the one.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning. At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. Realinvestmentadvice.com.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
The Real Investment Show YouTube channel has all our videos ready for your easy access, like Technically Speaking Tuesday, Financial Fitness Friday, and the latest analysis from Lance Roberts and Michael Leibowitz. Subscribe and bookmark our YouTube channel at realinvestmentadvice.com.
You're listening to The Real Investment Show.
And welcome back to the show this morning. Talking with Michael Leibowitz here a little bit about volatility, the volatility index in particular. And one thing Mike mentioned earlier, and I wanted to talk about this really just in passing, is that he talked about implied volatility. And if you're a person that trades options on stocks, so like you buy a portfolio of stocks and you want to buy calls on them or you want to write puts on them, understanding, if you don't understand implied volatility, you're really hindering your ability to be effective at doing option trading on your stocks, because implied volatility is what drives the premium or discount on the options. And so really understanding implied volatility and how it relates to call option writing or put buying against a basket of stocks is very, very crucial to becoming successful at that. And it's a key driver. Okay, having said that, Mike, so, the one thing that again, let's kind of recap our conversation for those just joining us. Volatility has been rising. There's definitely been a pickup in volatility. If you look at the volatility index, really kind of since July, when we started getting into the whole yen carry trade blow up, etc., volatility started to rise from that level. So August, September, and really into the beginning of October, volatility had been rising. And, the interesting part about this generated a lot of concern that, this rising volatility, it always precedes big market crashes. So you better beware, the volatility is rising, but yet the market just keeps making new highs. And, I think there's an important understanding that investors miss. They look at the volatility index and say, oh, well, it's rising, so that means a crash is coming. Volatility really doesn't work that way historically. It may slowly kind of trend up ahead of a crash, but when the markets are actually crashing, volatility is spiking vertically. It's not a trend. It's a straight moonshot higher. And by the time that you realize that volatility is giving you a message, it's almost too late. You have to be almost lucky to trade volatility, to be long volatility, because it happens so quickly. Go ahead. Did I lose him? Is Mike there?
Yeah, I'm here.
Sorry.
No, hey, I'm sorry. No, you're correct. You're correct. And we just saw with this yen carry trade, volatility was inching up, and then it spikes up to 40 in a day or two, and it drops pretty quickly right back down. So, if you knew the Japan carry trade was coming, potentially you could have made a lot of money, but you also would have had to, almost by definition, get out too soon, because it's going to come back down just as quick as it came back up.
Right. And
volatility spikes like that all the time, not all the time, but it, somewhat frequently. So again, I think, for most traders, implied volatility should be a tool, something we look at. Trading it is extremely difficult. I think the only way to profitably trade it is to try to stay short it. And you're betting that volatility ultimately comes back down to the average, which it will. But if you are shorting it regularly, it's the kind of thing where you're going to make a good amount of money until one day you can lose a lot of money.
Right.
But we were talking about the different other indices. So we talked about put call skew, and what put call skew right now is telling us is that people are paying more for puts than calls. So that's a little bit bearish. But then there's the put call ratio, which measures volume of puts and calls, and that's at like a 2-year low. So people are paying more for puts, but they're not putting really much more money into puts than calls. So we're kind of getting mixed signals from the VIX right now. The one thing I pointed out on my in the article, I went back to 1994, and I just said, how many times was the VIX above 20 and the market sitting at records, or within 1% of a record high? And you mind if I share the screen?
Yeah, please go ahead. You can keep talking while you're sharing your screen, by the way.
I'm not that coordinated. See, you screwed me up, Lance.
That chewing ball. It is live radio here, so nothing to worry about.
Okay, so you see my screen, I
Yes,
assume.
we're good.
Okay, so what you see is, again, going back to 94, the S&P is in green, and we know what that looks like. And then occasionally you have these red bars. And again, those are bars where the VIX was over 20 and the S&P was at within 1% of an all-time high. From 1997 to basically New Year's Eve going into 2000, there must be about 50, 75 of those red bars. It happened constantly. The VIX was constantly rising alongside the S&P. And when we first got those signals in 1997, you could have said, beware, this thing's crashing. And at that time, valuations were high. Mm-hmm. But we went from about 750 on the S&P 500 to about 1,500 over those next 3 years, despite the VIX trading over 20 relatively constantly. Then, you have to go all the way right on the graph. There's one instance in 2016 where nothing of consequence really happened after. And then during the recovery of the pandemic, not before the pandemic, but the recovery from the pandemic, there's another slew of bars there that just accompanied the market straight up to the top before it ultimately sold off in 2022. So it can be a feature of a bull market, not necessarily the warning of a bear market. And that's something to be careful of, because we've had a couple triggers in the last few days as well. So we see the red bars, and I think that's what's getting the media attention. Mm-hmm. But that is, is this another 3-year run for the VIX and the S&P where they kind of both stay elevated? Is it a warning? We don't know, but it's something that we watch closely. We and appreciate that there's potential upside, potential downside. We're not necessarily trading it, but just paying attention. Like it's another form of technicals. What are people thinking? Are they bullish? Are they bearish? What's the sentiment like? And this is just a great tool to use for that.
And look, to take that chart that you just had and you say, well, yeah, but see, the crash did come, right? Yes, in 1997, 1998, 1999, the market doubles, but yes, eventually the crash came. And that's the point that we're trying. I don't want to confuse anybody saying, hey, just because VIX is rising, that means, the bull market's fine. You don't need to worry about anything. Again, going to 2020, we had 2 years where the VIX was constantly, steadily rising in terms of a trend. And then you had 2022, where we had this choppy 20% correction for a year that was just miserable to live through, and that brought the VIX back down. And so Mike and I are not saying that the VIX is not important. We're not saying that you shouldn't be aware of it, and we're not saying that it doesn't necessarily not signal that the markets are going to have a correction. The markets are going to correct at some point. But what Mike and I are trying to tell you is that just because you're getting a volatility signal here today, it could be 2 years before the correction actually occurs. It could be next month, right? This is the point about volatility. And again, the thing about volatility that's important is that it is something that moves very quickly when things go wrong. So volatility is, and Mike and I, we have a portfolio that we have what we call our platinum portfolio that we run for our high net worth clients, which has options in it. And we have bought options on the VIX, long and short, from time to time, to hedge that portfolio. And we had bought some VIX calls, a couple of months ago that we've been selling a bit along the way and taking profits, because the VIX has been trending higher in that time frame, and we were worried about the upcoming election. So we bought those VIX calls to hedge our portfolio going into the election. Now we're almost there, and volatility index is now starting to come back down. As I said earlier, we're now starting to trigger an actual sell signal in terms of the MACD sell signal. That's suggesting that volatility is going to fall into the end of the year. So back to our original conversation, and I'm going to wrap this conversation up. Mike and I have some other stuff to talk about on the other side of the break. But this is the problem with the VIX, is that you can think it's giving you a signal, and then all of a sudden everything kind of normalizes and it goes back down again, and the market's fine. Or it can be starting to rise, and you think it's giving you a signal, and then all of a sudden tomorrow morning you wake up and the VIX is at 100 because you had a yen carry trade blow up. And then it's over. Volatility drops straight back down again, and markets go back to doing what they're doing. trying to trade your portfolio based on the VIX is extremely difficult because it requires precise timing. And unlike other aspects of the market, volatility, to get it right, you have to be as much lucky as you have to be just accurate in terms of your timing. And it's just amazingly complex. And so Mike and I, neither one would recommend using the VIX to trade your portfolio. Now, if you want to use VIX options, that's a different story, and that's a whole different conversation. But, just because the VIX is trending higher right now does not mean, as Mike just showed, and his article's on the website right now, realinvestmentadvice.com. I suggest you download and read it. It's a great article about this. But it doesn't necessarily mean a crash is coming tomorrow. Maybe in a couple of years, but not tomorrow. So just continue to manage your portfolio for what it is. All right, we'll come back. We're going to wrap up the show. We got to talk a little bit about economics and Fed right after the break. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
Medicare open enrollment is underway. If you need Medicare insurance coverage, RIA advisors can help. Understanding Medicare choices, enrollment deadlines, and costs are essential to your overall standard of living in retirement. The wrong choices can cost you thousands in lost benefits and penalties. Make sense of Medicare's alphabet soup with RIA advisors' online resources and one-on-one partners to help secure the healthcare insurance choice that's right for your lifestyle and budget. Click on the insurance tab at realinvestmentadvice.com today. realinvestmentadvice.com.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. realinvestmentadvice.com.
The Real Investment Show.
Small businesses are discovering that attracting and retaining top talent come down to more than just salary. In today's highly competitive job market, compensation is more than just wages. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Healthcare and retirement plans can make the difference in hiring and retaining the best employees. We can show you how to build an affordable, effective employment package that delivers true value for your workers and your business. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
So my wife was actually listening to our show the other day, which is unusual. But she heard me complaining about the coffee that we have here at the office. And she's like, why don't you just drink tea, honey? Well, fine. If you just want to take away 87% of what little joy I have left, then yes, I'll start drinking tea. Drinking tea. I'm not English.
Tea sip.
Tea and scone.
I'm not from New England.
Or Austin.
Or Austin. Anyway, we're okay. If you're from either one of those places, we're just joking. Don't get offended. All right. If you want to drink tea, that's fine. Anyway, no, I will drink crappy coffee over tea. Right. Just mostly just because I need the caffeine injection. That's most of it. Anyway. All right. Back to the show. Mike, a couple of things going on here. Today, we're going to get retail sales report out this morning. As I mentioned at the outset of the show, it is very likely because of calendar effects, we're going to have very large seasonal adjustments to this report this morning. And, that shows that retail's, consumers are doing fantastic. Obviously, no concerns about economic growth. whether or not that's really the case on the ground is a different story. We're going to, when we start hearing from a lot of the retailers like Walmart and Target and these other guys, I think we're going to get a much better sense of what's actually going on with retail consumers. But the numbers today, this morning, that come out at 7:30 should be, or expected to be, pretty strong because of those seasonal adjustments. The question comes, we just had a really, really strong employment report, came out much stronger than expected. Now you have potentially, and we don't know the number yet, we're making some assumptions this morning, but if we do have a really strong retail sales number, we've already, heard from a couple of Fed speakers. We've had just a rash of Fed speakers out as of late. And we've heard from a few of them that, cutting 50 basis points, not likely at the next meeting coming up right here after the election. Cutting 25 might be becoming a little bit more challenging even at this point with the data. Because again, if you're worried about combating inflation, continuing to cut rates potentially exacerbates that inflation push if you do start to really spark a lot of economic activity and get, the economy growing strongly. And again, talking about the economy growing right now, the Atlanta Fed has the economy pegged right now at about 3% growth for the third quarter. So what do you think? Is the Fed kind of pushing themselves into a box here, talking about cutting rates now, or do you think they'll kind of continue just at 25 basis points per meeting into next year?
Well, as we saw with boxes, the Fed, if we go 2 weeks before the last meeting, everyone thought the Fed was doing 25. The Fed changed their box about 3 or 4 days before the Fed meeting via the Wall Street Journal, and the market was expecting 50, and they got 50. Mm-hmm. So I don't think they're necessarily boxing themselves in. I think they've made it clear they would like to do 25 at each of the next 2 meetings. They put that in their quarterly economic projections. Most of the Fed speakers, except 1 or 2, have said that there's still rate cuts probably at the next 2 meetings and beyond. And strong retail sales may affect it. There's a lot of weird seasonals going on with today's number. Mm-hmm. But the last 5 retail sales numbers have averaged to be 0. They've all been right around 0, but the average is 0.
Right.
That's while inflation is 2.5%. So retail sales are really going down 2.5% on a nominal basis. So, the economy's not weak. We're not in a recession. It's a good economy. There's nothing in the labor data telling us that we're going into a recession. It's weakening, but weakening from very high levels. Nothing in the economic data is saying we're going into a recession or necessarily that we're booming either. We're getting this nice Goldilocks economy for now. Again, we're kind of still in this normalizing process, and things change quickly. So, if I'm at the Fed, I say, okay, everything is kind of working smoothly. The one issue we still have is that interest rates are at 4.75%, 5%, mm-hmm. and they need to be down at 3.5% to keep Goldilocks going. Because if interest rates stay much higher, it's going to keep weighing down on the economy. It's the lag effect is still there. And there's a huge amount of corporate debt coming due next year. So ideally, the Fed would like to lower rates at least a little bit to allow some of those corporations to issue debt at cheaper costs so that they don't have to lay off people. They don't have to cut projects in order to make up for that added interest expense. So, again, I think the Fed is just trying to normalize interest rates. These interest rate cuts are not necessarily economic stimulus like just about every rate cut we've seen in the past. Mm-hmm. And I think when you can get your mind around that, you get a better feel for where the Fed would like to go. Now, that doesn't mean we can't slip into a recession next year. First quarter, second quarter, things happen really quickly.
Right. And again, I think an important point is to your specific point, Mike, is that we've had so much government spending, right, that's been supporting economic activity that a lot of that spending is slowly reversing out of the system. And so, the actual growth rate of the economy is probably closer to 1.5% or 2%. X government spending, where you don't have the Inflation Reduction Act, the CHIPS Act, all this other money just kind of being shoved into the economy. Of course, there's also a lot of money that's been spent on, immigration issues and those type of issues as well, which is all supporting economic activity. So if we strip all that out, the economy is actually going to grow at somewhere around 1.5%, 2%, which is ultimately where inflation should trade, which is where the Fed is trying to get to. And as you've talked about before, interest rates are just too high relative to the current level of inflation and economic growth.
Right. And here's, it kind of inflation and the deficit are I don't know what the right word is here, but people don't think about them in the right context, right? It's inflation has gone up a lot and it sucks. And I get it because I buy a lot of stuff too. My wife certainly does, but wages have gone up too. And they've more or less kept up for most people, kept up with inflation. So yeah, things are more expensive, but you're making more money. Now, the same is true on the deficit. Everyone talks about these spending numbers, and I'll be the first to come out and say they're awful. They're just pushing our economy down in the future. They're weighing on the economy. It's unproductive debt that sucks. But if you look at debt to GDP for the U.S. government, it's been flat for 2 years. So the government, as a percentage, isn't spending any more this year as a percentage of GDP than they were over the last 2 years. It's still a big number, but it's not, it's not growing massively. So again, it's nothing but bad news, but it's also not the massive bugaboo that people think it is. And if the government spends the same amount of money this year as next year, that's 0% growth. That's a recession. So the government's contribution to the economy, if it's zero, is adding nothing, even if they're spending whatever it is now, $2.5 trillion a year. They have to spend more. And as a percentage of GDP, they're not spending more for the last 2 years. Again, I'm not condoning what the administration has done. I think it's horrendous how much money is being spent and the future cost of that. But as we kind of look at the economy now and the government's role in supporting the economy, which is big, if they don't increase it significantly, they're not really helping. They're helping the economy, but they're not helping the growth rate of the economy.
Well, no, and that's an important fact. I mean, government spending does go up every year. And, because we do continuing resolutions, we don't actually do a budget. But fortunately, the economy has been growing faster than the increase in the spending, which is how when you take a look at debt to GDP, it's been flat for 2 years because the economy has been growing very strongly. But again, this is, this kind of comes back to that whole concern about a resurgence in inflation, Mike. There's been a lot of talk over the last, couple weeks in particular, particularly following the last CPI report, that inflation is now set to come surging back, but which has caused interest rates to go up, et cetera. But really, the economic data doesn't support that either.
No. The economic data supports that inflation is slowly coming down. I actually filled up the car the other day for $2.90 something. It hasn't been under 3 here for a long time. So, the price of crude oil is now back to $70 a barrel after we had kind of the Israel-Iran tit for tat. And there's nothing in the inflation numbers that tell you that it's going to start soaring again. Maybe it'll sit around current levels for a little while, but I still think the general trend down in inflation will be lower. And with it, as kind of people get over the inflation shock of a couple of years ago, they'll learn to accept that we are in a 2%, 2.25%, 2.5% inflationary environment, not the 5, 6, 7% environment. And that's actually the topic of my article, hopefully for next week, is memory inflation, which is actually a psychological term, but we can apply it to economics.
There you go. Well, and again, as we always note, then just as a disclaimer, when as we're kind of coming out of this conversation, inflation is measured over year basis, and so it's important when you look at inflation, you're not looking at the inflation of a price itself. Inflation is always going up. It's the rate of change of inflation that we're always talking about. And that is what we're talking about coming down. Yes, and prices are still high. Prices are still going higher. Article out this morning talking about shrinkflation and toilet paper. That's inflation, right? But the rate of change of that inflation is what is slowing down, and that's what the Fed is focused on. All right, wraps up the show for today. Mike, thanks so much. Get by the website, realinvestmentadvice.com. Be sure and smash the like button for us. We certainly appreciate it. We need those likes. It certainly helps us out a lot. We do appreciate it. realinvestmentadvice.com for your questions and comments. We'll see you back here tomorrow for Financial Fitness Friday.